Dear ICCS members and friends, good afternoon and thank you for joining us with this webinar session organized in partnership with ICCS Finance Committee in Intesa Sanpaolo, a committee member in Intesa Sanpaolo, and Oliver Wyman. My name is Carola Capone and I'm the Marketing Executive at ICCS. Thank you once again and welcome. I'm very happy to introduce you to today's speakers who are going to give us a deeper understanding on how finance industry can support the climate transition. We have connected with us today Claudio Lago de Lanzas, Head of Oliver Wyman Southeast Asia, and Timothy Collier, Head of Oliver Wyman Indonesia and co-lead Sustainability Platform in Southeast Asia. Without any further ado, I shall now leave the word to the speakers. We'll start today's presentation. Thank you.
Thank you, Carola. Grazie, Carola. And ciao, buonasera a tutti. That's going to be all my Italian today. Thanks a lot for your time and having us. Yeah, it's a great pleasure to present on a topic that probably, if you ask us 12 months ago, never would have thought that is so top of agenda of every single bank. Yeah, it is something that as Oliver Wyman, we're currently working, I would say, with almost every institution on this topic. When probably 12, 18 months ago, we had just a handful of clients that were focusing on that. And as we'll explain later, this is actually also the case for us now in Southeast Asia. Especially banks in Singapore have put a lot of attention to this, the same as the regulators. So today we wanted to do two things and probably spend 20, 30 minutes and then open for questions. Yeah, I will walk you through 5-6 slides on an introduction on the problem statement, why is it so important, what some of the regulators are starting to do, and then Tim will walk us through more in detail on what should be the role of the banks in this space. Yeah. So this stat is quite interesting. It was quite shocking the first time I read it. The time that the carbon dioxide remains in the atmosphere can go up to 1,000 years. What that means is that the net zero commitments that a lot of the banks, governments, corporates are starting to push becomes even more important. Because everything, like even a slightly positive carbon emissions, will mean that those positive are going to be up there for over 1,000 years and having an impact on temperature and the rest. Yeah, so it becomes very, very critical. And I think after a long years of debate, and I'm not a scientific, but finally the scientific community seems to be broadly aligned that there's a material impact and that we need to act on it. Yeah. I like this quote from Mark Kearney, the former governor of Bank of England, yeah, that basically says that almost every financial assets will need to be reviewed and reassessed because of the sustainability or climate risk. And that means they will need to align, as Tim will explain, it will drive a lot of business opportunities for the banks, but it also will drive risks, not only for banks, but overall economies. Like I was reading yesterday a paper from the vice president of Nigeria, saying that we will need to do something on sustainability, but it will have a massive impact on the developing countries. If you go to Indonesia, this is a very heated topic, and when you talk with some of the even local authorities, it creates a big problem because they need to balance climate risk together with economic and development risk, yeah, and poverty. But it is true that those that don't adapt will eventually cease to exist, whether that's corporate banks, investors, and so on. So far, as you can see, in the last year now, up to 70% of the governments have made now net zero commitments, and that's a huge growth over where we were last year or 2019. Sorry. And one of the main reasons of all these countries coming and all the corporates and banks now following is, I'm sure you saw the investor note from BlackRock, where they started to see that they're going to treat differently those investments that are more sustainable and sustainable versus not. And that has eventually led for a lot of the corporates and banks and the rest to start to focusing on it. Yeah, so it is really important and it's top of the agenda of all the government, all the institutions, all of our clients. I find this quite shocking is when we do an analysis on, and this is focusing on Europe, yeah, but it's the same or even more extreme in other parts of the world, is right now there's around 5 trillion of balance sheet that the banks are lending to European corporates. And close to 95% of those banks have made net zero commitments or have defined their ambition aligned with the Paris Agreement. So what that means is they're trying to make sure that the balance sheet is net zero over the coming years. Yeah, and there's still a lot. It's 2050, so it's still a long period of time, but they need to act in the relatively short to mid-term. Yeah, if you compare the other side, that is how much of the corporates are actually already sustainable, let's say on net zero, therefore below that 2 degrees or 1.5 degree commitment from the Paris Agreement, it's the opposite. More than 95% of the corporates are not there yet. So what this means is a huge transformation of the corporate world or economy that will need to be sustained by finance. And as I said, Tim will explain later more on about this one. If you look into sectors, there's actually the majority of the sectors in the economy are low risk, so therefore they already aligned to net zero. But there's a lot of that risk that sits into some of the more heavily funded industries that have either elevated immediate risks already. Coal and mining, you start to see banks saying that they won't have any new loans to the sector, or that they're going to change and they're going to reduce their exposure. But if you look into a lot of the sectors, those are the sectors that are actually heavy in Southeast Asia. Yeah, oil and gas clearly key for a lot of the economies like Indonesia. Shipping critical for Singapore, same as chemicals. Mining also in quite a lot of other countries. So generally speaking, there's going to be a huge transformation in some of the sectors. We're doing, for example, work with one of the leading banks in the region. We're defining the 8-9 key sectors where they're going to look into and understand the pathways and how can they reduce that. However, if we look into the regulations, the regulatory side in Asia, we actually see very different priority depending on the geography. So Singapore has made this a top 1 priority. I'm sure you have seen and read and talked to a lot of the regulators about this. MAS has already come out with a lot of stress testing requirements for banks that actually even non-Singaporean banks start to look into it because they will need to comply. So for a lot of the regional banks that have a large presence in Singapore, that has also become a priority. Yeah, other markets like Malaysia or India and probably also Indonesia are still behind on that. But as I said, that also has a strong implication because of the impact on poverty and the overall economy. So they have a much more difficult situation to balance those. Yeah. So very quickly to finalize, before I hand over to Tim, for us, we believe that green is the new digital. Yeah, the world has dramatically changed in the last 10, 15, 20 years because of all of the digital innovation, and it's still transforming. We believe green is going to be the same over the next 20 to 30 years. Yeah, and this is really driven by, as I said, government is putting a lot of pressure, investor activism. I mentioned BlackRock, but there's quite a lot of other ones. Consumer activism, and Tim will explain a little bit on how to tackle that. But that's less scientific and rational than more on the investor and government policy. But it becomes very, very important, yeah, because they can drive a huge impact on corporates or banks, as I'm sure you have seen on some of the backlash that some of the UK banks got after actually reasonable, good communication and good intents, but not aligned with that consumer activism. Yeah, as we said, financial sector ambition, it is now a number 1 priority, I would say, for most of our clients. Yeah, we believe similarly to where banks were 15, 20 years ago, for the first mover advantage for some of the banks. It's still early stages for a lot of the banks. A lot of them are still, and we're all learning about it and developing the solutions. But so we believe those that get ahead of the curve will have a great opportunity. And we see some of the growth in the bond issue in Asia Pacific on the green side, on some of the survey that we did, and slightly biased on the economic background, but clearly it's a key priority also for the individuals. Yeah. So as I said, this was more to introduce the background that I'm sure you're quite familiar with. Happy to take questions at the end. Tim is going to walk us through now more some of the implications on the finance side and the role that banks and the sector can play in this. So Tim, over to you.
Okay. Thank you, Claudio. And good afternoon, everybody. So I then start to think about how does this play into financial institutions, and I guess in particular here we're focusing on the role of banks in catalyzing responses to climate change. So as Claudio says, the frequency and severity of physical risk events caused by climate change is increasing, and that already has a direct implication on the banking sector. But it's also leading to large-scale transitionary policies and large-scale changes in technology and in the real economy. So we see big physical risks, big policy changes, both of those feeding through into big changes in the real economy. So even if financial institutions were doing nothing, climate change would have a pretty big implication on banking, because it would be changing the nature of their clients, it would be changing the type of investments that those clients are starting to make, and it would be directly impacting the activities of those clients that are affected by physical risk. In reality, the policy world has decided that it wants the financial sector to front run the shift towards a low carbon economy. And the pressure from policymakers and regulators has come in advance of the real economy changes, with the view that a reallocation and a repricing of capital can help to catalyze and accelerate the transition to a lower carbon economy. So all of that adds up to a lot of change and a lot of pressure on financial institutions to change the way in which they're financing and change the way in which they look at climate change. Claudia, next page. Next page, please. I think, Claudia, you've got the document. Thank you. So that really is coming about, that really translates into two distinct actions that we see banks taking. So the first one is, I need to understand what is the impact of climate change on my on the risk that I have in my portfolio. And that comes from two sources. So firstly, I'm financing activity which is affected by the physical changes of climate risk. So if I'm financing particularly agriculture, which is in areas which are vulnerable to droughts or fires, or I'm financing real estate, which is vulnerable to the increased severity and frequency of storms, that has a direct impact on the risks that I'm taking in my portfolio. And then the second part of that risk equation is, if I'm financing an activity which may become redundant or uneconomic as a result of the technological change which is being driven by the transition, then that also exposes me to a lot of risk. So one of the examples I like to think of here is one of the things that's required to get to a transition is that the world adopts electric vehicles, and this seems to be one of the things which is most likely to happen in the transition plans. And the effect of a mass large-scale adoption of electric vehicles is a dramatic reduction in demand for petrol and diesel oil, and consequently a massive reduction in demand for refining activities. And that means that the only refineries that will continue to run are those which are the most efficient. And consequently, if you are financing refineries that are in the second half or even not in the top quartile of efficiency ratios for refineries, those are at risk of becoming stranded assets in the relatively near term, because these are trends that happen relatively soon. And I think as we start to think about what are the shape of some of these assets that exist across Southeast Asia, you can see actually there's quite a high risk of some of those effects feeding through. And then the second half of this equation is, even if I'm not worried about the risk to my own portfolio, what should I be doing as a bank to be accelerating the shift towards net zero? How can I reassure my investors, my customers, my regulator that I am financing the right type of activity that's consistent with government policy and consistent with a move towards a net zero economy? Next page, Claudia. Now, so what you see on the left-hand side here, in terms of understanding the risk of climate change to banks' portfolios, we as Olaf Wyman have developed a methodology that decomposes the different effects of the transition and the impact of physical risk events, puts those through the financial drivers of performance for individual corporates, and then translates that into the risk of credit risk downgrades over a long period of time. And we run that with 3 scenarios that are created by the ENGFS, one of which is an orderly transition, one of which is a disorderly transition, and one of which is really no transition, and therefore more physical risk. And we tested this on 24 companies, 24 Singaporean companies here, and what you see is the results on the left-hand side, which shows the number of companies that have at least a 2-notch downgrade at different times if you play through those scenarios. And the picture here is quite consistent with what we've seen in other developed economies, which is there's a lot more risk from the transition than there is from physical risk in portfolios at the moment, and that risk is weighted towards 2035 and 2045 because that's when a lot of the policy changes have larger effects. But even still, here you see 6 or 7 out of 24 companies, so something like a quarter of the total portfolio is at risk of a material downgrade by 2035 as a result of transition risk. So it's not it's a material, if not imminent, risk to these banks' portfolios, and that really plays across a large number of sectors. So coal is a paramount example. A lot of financial institutions are really pulling back from coal, but there's a risk of an accelerated transition, leaving those coal assets as stranded in the near term. Power and utilities, depending on where they're sourcing their energy from and their efficiency, similar kind of issues. Metals and mining, depending on exactly what it is that you're mining, again, differentiated impact, and so on and so forth through really every industry. Next page, Kadia. And so what we've seen globally is banks, one after the other, coming out with a set of targets and ambitions for how they're going to align their portfolio to a net zero ambition. And what you see on the left-hand side is a pullout for the power sector, which is quite typical of what we're seeing across the industry. So here you have JP Morgan, Barclays, and ING, all of whom have got public net zero commitments for a number of sectors. And what that means in practice is understanding from the science what is the required path in terms of emissions and emissions intensity for that sector. And here we assume the world still needs power. In fact, the world needs more power in all of the scenarios that are developed. But instead of producing that power at 500 tons of CO2 per megawatt hour, you need to be able to do that for 0 by 2050, and that means a shift in the source of power, a reduction in any and the capture of emissions that's coming out of that power generation as well. There's a lot of technical details around the subtlety of how this is done. Here we see CO2 on the left-hand side. Others look at CO2 equivalents and therefore include other gases. Here we see an example which is based on emissions intensity. Others are looking at absolute levels of emissions. Exactly how you measure companies and how you forecast what they'll do over time are important technical details. But in the broad scope, we see the majority of the banking industry moving towards making similar commitments, which is going to drive them towards pushing their clients to be reducing their emissions, or else needing to make pretty radical decisions around who they're willing to finance and who they're not willing to finance within a given sector. Because here you can see a 50% reduction in the next 10 years in terms of the emissions intensity for the power sector, and that's not easily achieved. Next page, Claudia. So that then involves mobilizing the whole of the bank. We see this really as a whole of bank topic. Those that are getting it right, it's being driven from the very top of the house. A lot of board engagement, the CEO driving this throughout the organization. It involves risk management, it involves finance. It typically involves the creation of a sustainability office that is reporting directly into the CEO, and it involves deep involvement of all of the major businesses, particularly corporate banking in the first instance. But actually we see opportunities to be looking at corporate emissions also in retail and wealth and elsewhere in the organization. Next page, Claudia. Yeah, I think along with the risk aspect and the need to disrupt the portfolio, there's actually a lot of opportunities that come for banks from transition. So there's going to be a need to build a lot of new infrastructure. There will be a number of new companies being created. We see governments, as they start to go from more ephemeral ambition statements towards funded and planned out plans as to how to get to net zero, are starting to commit large amounts of investment budget, and that kind of public-private partnership space is creating pretty bankable new opportunities for banks. So I think those that can get ahead in the green space will not only gain with investors and customers and on a reputational side, but they also stand to be the winners in a new economy. And if the world is to transition towards net zero, that adds up to an industrial revolution really across all sectors of the real economy. Next page, Claudia. Okay. I'm just going to spend a couple of pages then to the other thing that we've been looking at is, if these banks that have come out with big commitments, they've not always got a lot of credit for them, and often actually the reaction to the commitments that they've been made has been one of skepticism and cynicism. So Barclays is a good example. A lot of thought went into their blue track methodology. You know, they had a very quite a sort of scientific and analytical approach for coming up with targets, but within a short period of time, they were under attack for making that commitment at the same time as increasing their overall exposure to the oil and gas sector. So we think it's important that at the same time as coming up with the right answer for what you do with your portfolio, you think very carefully about how are you going to engage with your customers and how do you engage with the stakeholders in terms of how you're communicating your message. So we went out and we surveyed people, and we surveyed attitudes to climate change and how they thought about climate change with respect to the financial institutions that they dealt with. And interestingly, that the themes that come out are, firstly, that customers see things in quite black and white terms. There are things that are good and there are things that are bad. So wind and solar are good. No one's really looking at the emissions profile and any downsides to those. Coal, oil and gas are all bad, regardless of what it is that they're doing. And that kind of black and white dichotomy is a key theme that comes out. It points you towards needing to be able to make quite clear and unambiguous statements around some of these aspects. The second point was customers felt more engaged by things which were personal to them. So wherever there was an action which directly affected them, they felt that more than they did larger but more abstract objectives. So a good example I think of here, which I think is on the next page, is there was you see here an example on the left of a bank that just said we're going to take away plastic credit cards so that we don't use so much plastic. which in terms of the overall impact on climate change is relatively small, but customers felt this was very understandable, it was very credible, it was very desirable, but this was, you know, an unambiguously good thing. Whereas as you move towards the right-hand side and you've got a bigger commitment to change the whole of the portfolio towards being net zero aligned, far fewer people understood it. The majority felt that it wasn't credible, and quite a lot of people felt that not very many people really understood whether it was even desirable, what was being pushed here. So that need to be able to do something which is personal is important. And then the third point, which is also illustrated well here, is long-term commitments into the future also don't play well with the general public. They feel not credible and much more easily gamed. Much more the general public takes a much more cynical view towards them, and that leads us to a communication conclusion, which is on the next page, Claudia. Sorry, we lost the page, which is that a good message here is one which is a small change which affects me today. So we need something which brings the immediacy, which brings the personalization, and which looks credible and not over ambitious straight away. Okay, next page, guys. So we see that therefore leading banks thinking about, you know, what is my strategy? What am I trying to achieve? I think I would say quite a lot of institutions have jumped into what they're going to do about climate and ESG, but without properly articulating what the business case is, what the case for them doing this is, and without the case for change being very clearly understood. What that leads to naturally is a watering down of ambitions and a reduction of commitment over time. So we think it's important to set the strategy, set the ambition, and understand the business case. We then think it's important that strategy is embedded into the business, that you have this steered not just from a chief sustainability officer, but directly into each of your businesses, that it's put into processes, it's put into tools, it's put into KPIs and incentives. Interestingly, one of the think point banks we're working with at the moment, all the leadership team have direct KPIs set for this year around how that institution is going about climate risk and the leadership that they can show in the market. We think it's important to seize the opportunities, look for where there are business cases as well as challenges to solve, and then we think it's important to bring stakeholders along with you, and that needs quite a thoughtful approach to internal and external communications. Okay, next page, Claudia.
I think we're done now, yeah? I
think we're done, yes, Q&A.
So I think there were some questions through the chat. So if you want, I can cover some of those.
Sure.
On that.
No problem. Do you want me to read it out loud?
Yeah, I have them in front, but feel free, yeah, if you want.
Yeah, it's just for the audience so they can, because
sure.
they're not able to read those.
Okay. Yes, please.
So the first question is asking, which booking center will emerge as best equipped and liquid sustainable bond market in the future? US, Asia, any other one? Who would like to take this question?
Anything that has a crystal ball, I'm sure Tim and I will have different views. I'll give you my view, and then I'll let Tim respond on his side. Yeah. Like if you look, and I'm now talking from memory, but if you look, I think into last year, volumes of sustainable bonds, you would have, I think it was around 50%, half of the market was euro denominated, so mostly booked in Europe. You would have, I think it was around 35-40% was US denominated, so also booked in different places. And then you had very small in other markets like Australia, UK, and so on. Yeah. So I think that's a sign that Europe in the last years is ahead of the game versus the rest of the world in terms of sustainable bonds and how much they care about sustainable green. But I don't think that is sustainable. I'm pretty sure that would end up reverting into more normal, like a split of liquidity similar to what you would have on regular bonds. So I would still think US and Europe will be the main booking centers, and then in Asia probably Singapore, and then a question mark on Hong Kong. Yeah? But as of today, it's heavily Europe centric. I'm sure Tim, if you agree, have a different view.
I think we'll see them emerge everywhere, and probably likely linked to where there are large sources of liquidity. So Europe, US, and Asia in the future.
All right. Thank you.
Second question.
Yeah.
So second question is, do you think? Yeah.
You can read it aloud if you want, if you prefer.
Yeah.
Okay, I'll go. Do you think we could see the emergence of sustainable-only banks? I would like to take this one.
Yeah, I'll take this one because it's quite close to my to my heart. So I think we could. So already some of these exist. I think there's an ING example in Europe has attempted to launch a green bank. Now, I see the possibility for banks to appeal to a tranche of customers that become increasingly sensitive about how they are greening all aspects of their life. And those customers, those that are eating plant-based meat, that are changing their travel habits, that are really looking across their own activity about how they can reduce their personal Scope 1 emissions, could become a source of customers that are willing to pay either in reduced interest rates on deposits or through subscription fees or other mechanisms, to be banking in a place where they know that all of their money is going towards very green or net zero aligned portfolios. So I do think this is possible. I think for where we are in Southeast Asia at the moment, the market's not quite ready there in terms of the demand to make a business case for a sustainable only bank. And I think there's a question mark as well as to whether that banking business case ever adds up. To me, it feels quite analogous to Sharia banking in that regard. And you see in a lot of markets, large Muslim populations that actually aren't that interested in Sharia banking. But if you follow the logic that group of customers will emerge, then I think that can create a business case for sustainable only banks.
And a couple of things I would add is one, as Tim was saying, you have banks in Europe. I think it's Triodos, it was aspirational in the US. So you already have some sustainable ESG banks in that space. I think, as Tim was saying, is we have tried with no success yet. But if anyone from UniCredit, Intesa, or others would like to pioneer the idea in Italy, we have tried to push on the same way some banks created a digital-only bank before they merged. Does it make sense you create a green-only bank where actually all of the assets and liabilities are only, especially on the asset side, is only focused on, let's say, sustainable companies or ESG compliant companies? As Tim was saying, there's quite a lot of appetite. It's the need, or you need to build a business case that it makes sense or not. Yeah, but there's definitely interest, at least from some of the incumbent banks, on does it make sense for us to set up? But so far, it's more within the banks.
Okay, so let's say there will be an increase that maybe are not fully focusing on sustainable, let's say, only. So green. All right, let's move to the next question. Let's say recently, few financial companies, among them UBS, got criticized because some of their investment programs not being full ESG or sustainable, as described in the financial prospectus or materials. How to manage such risk liabilities? Sustainability policy and paradigms change pretty fast. I would like to reply first to this one. Timothy.
Tim, go for it. Yes. No, Tim, go for it.
Because I think I'm muting myself, so.
I think either one of us happy to discuss. So I think it is a real challenge. Not only do sustainable policies and paradigms change, but there isn't even a consensus at one particular period of time as to what is enough and what is not enough. And I would say even within that, you can be fully following the science, and it still won't be enough for some activists. So I think banks will have to get used to the fact that they're going to be attacked by some activists almost regardless of what they do. I think also what this points to, and the changing in the paradigms and policies is important here, is the need for this to be a permanent capability. So it becomes part of how you do banking all of the time. You need to be continuously updating your ESG policies. The ESG investment mandates need to be getting continuously better and continuously changed, reflecting the science of the time. But you still, even with all of that, you won't be able to mitigate the risk that at any one time you're offering something which somebody in the world is not happy enough is green enough.
Would you like to add something?
I agree with that.
Okay. All right, so let's move to the next one. Do you see the rise of new financial products such as blue bonds for protecting marine life?
I'm a son of a navy in Spain, but I'm not an expert on blue bonds or marine. But I think what we're probably going to be seeing, it's quite a lot of niche investment products that are green or sustainable related. Do I think that the blue bonds are going to be exploding like the green bonds are doing now? I think probably not, because it will be important, but it doesn't have, I don't think it has the same media and investor attention that you have on the climate change side. So I think, yes, I'm sure there will be some growth there, but I don't think it will reach the growth that we're seeing on some of the green bonds. Again, it's a crystal ball, so I know Tim, maybe have a different view on that.
Yes. Okay. I think, well, Tim, what do you think? Are you on the same side?
I agree, right? I think there will be a market for it. I think it'll be a smaller market for the green.
All right. We still have 3 more questions. Another one is asking, thank you for the very interesting presentation. Could you please give us an indicative breakdown of the economic sectors with low environmental risk exposure, and more in particular, the ones that will benefit from this climate transition?
I'm not going to perfectly answer that question, but I'll give you a qualitative answer. So the kind of sectors which have low amounts of climate risk are things like services and technology, which are not heavily exposed to physical risk and not heavily exposed to transition policies. I think the second half of your question is actually a slightly different one. So some of those those sectors may or may not win from climate transition. They're kind of neutral to the climate transition. I think the sectors that stand to win from this will be subsectors of those which are most heavily affected by the transition. And what I mean by that is, in order for the world to transition towards net zero, it needs a radical overhaul of where we get power. So wind, solar, but also just any company that can transition towards renewable energy and do so by winning financing agreements with governments, stand to be big winners from this, because there needs to be a vast investment and injection of capital into those sectors. And then the same is really true across most heavy carbon emitting sectors. So power, transportation, shipping, logistics, manufacturing, construction, real estate. All of those are sectors that will need to undergo very large transformations. So we'll see big losers from companies that are too heavily tied to old technologies and move too slowly. We'll see some losers in companies that move too fast into the wrong technologies, undoubtedly. But then we'll see big winners emerging from companies that are able to harness new technologies, to partner effectively with government, to launch new technologies. I mean, it's a little bit like the move from horse-drawn carts to motor cars. If you get it right, you're the next Ford motor car of the 21st century. And I think there's some big winners to be had in that, really kind of across all sectors of the the real economy there.
Okay, thank you, Timothy. I think your answer was quite full. I don't know if Claudio would like to add something. No, go ahead. Okay, next question. What are the long-term implications of this new sustainable finance strategy, and which industry would benefit the most from it? I think
maybe I'll have a go on this one. So I think part of, like, the second part of the question is what Tim has been describing. Yeah. But I think what this means is, from a sustainable finance perspective, it means that the corporates and SMEs will need to change and restructure the way they operate and the way they run their own business. So from a finance perspective, it means different things. Yeah, one is there is a lot, and that's a lot of the work that we're doing now, for example, on sustainable or climate or greens stress testing that the regulators are demanding. So a function is going to be like a corporate. If they don't change, the same way you would have your PDs in your portfolio, you will actually have a higher PD because if there's a carbon tax or any other measure, those companies are going to be heavily impacted. So I think from a finance perspective, the point number one is your portfolio is going to look it's going to look different. And if you are in a lot of less sustainable companies, you're going to have a more risky portfolio. Yeah? So I think the first one is on the risk profile that will need to link, as always, with the risk appetite of a bank. I think the second one is it comes also with opportunities on transforming those corporates, whether it's on investing on new technology. So if you take an airline, SQ or Malaysia Airline or whatever other airline, they will need to invest into changing the fleet. Yeah. So that require new investments and new financing. And it also impacts in some new sectors and some new capital ventures. So we start to see in early stages, but a lot of capital going into those new startups that focusing a lot on green technologies. We just run for MAS, we run a hackathon where they identify 15 companies across the world. And we had, like, I don't remember now the number of participants, but participants across the globe that are looking at that. So there's actually also new investment money, investors' money going into those types. So I think it touches almost everything that the bank does, yeah, whether it is traditional lending, new business opportunities, or more private capital side.
Right. Thank you, Claudio. Okay, I think we still have time for one more question. Actually, there's another one coming in. Okay, let's move to this one. Can you please clarify how green bonds works? What are the KPI required, and who monitor their compliance?
Yeah. Again, I'll give my view, and Tim can add. Is usually you have, I think there's two type of KPIs. They're more what you can label it how you want, like input or output. So it's more like you need to spend X% of this money needs to be spent in green projects, or it needs to be spent in R&D linked to that, or in FTE perspective. But there's a lot that is also output, yeah. So that's usually carbon intensity. So does it link to your carbon reduction in carbon intensity? But it'll depend on the bond and who's the issuer. I think the other one is, and who verifies it. I think if I recall correctly, most of them, you need to have an independent party that actually verifies that you have met the KPIs. On this one, there are different type of providers that do that. Tim, if you want to add anything on that.
I was just going to say, I mean, there was a Bloomberg article overnight on the weakness of green covenants that lenders are putting onto green lending and green financing. I would say this is it's an evolving industry, and as financial institutions bring out their own net zero commitments and then start to try and achieve them, and as those become more and more difficult because you move away from year naught in a line that goes steeply down towards more difficult parts of it, the need for them to be putting in place stricter and more enforceable covenants will become just greater. So yeah, I agree with everything that Claudia is saying, but I also think this will change over time and become a much more important part of the green financing world.
Thank you, Timothy. Okay, I think, yeah, we can do this last question. So do you think that the lack of financing on fossil fuels might increase the electricity price and its volatility and have an impact on economic growth? Who would like to take this question?
I'll take it. Yeah.
Okay.
So I think the answer here is yes, yes, and maybe. Right. So if we shift from fossil fuels to other sources of power, in the short term, they'll be more expensive. Although that is coming down, and the marginal cost of producing wind and solar is getting pretty close now to the point when, and once up and running, is arguably cheaper than the producing power from fossil fuels. Certainly increases volatility, because if the wind's not blowing and it's not sunny, then you can't do very much with your wind farms and your solar panels. So there is a need to supplement renewable sources with more reliable sources that you can turn on and off. And then does it have an impact on economic growth? I think it depends on how much investment and financing is going into the transition at the same time. So if a reduction in financing for fossil fuels is coming at the same time as trillions of dollars are being spent on new infrastructure and technology and on a green energy revolution, then that will more than offset the impact of higher electricity prices on economic growth.
All right. I thank you, Timothy. Thank you, Claudio. I don't think we have any more questions. We are perfectly in time. So just would like to thank you once again for your extensive knowledge on the topic and for this interesting presentation. And I just want to remind you all that if you would like to rewatch this webinar or download the PPT, you can do so on our website, on ICTS website under the video gallery. Thank you once again to Oliver Wyman, and thank you, Claudio and Timothy. And thank you everyone for joining us.
Grazie, buona serata.
Grazie a voi. Thank you.
Bye.
Bye.